Are you tired of feeling unsure about the best way to invest your hard-earned money? Do you find yourself wondering if there is an optimal order to invest in different types of assets? If so, then you won't want to miss out on this video. We're going to explore the secrets of investing in the right order, so you can maximize your returns and build a solid financial future. Make sure you watch the video until the end so you know the correct order to invest your hard-earned money. Welcome to the Finance Bowl, where we give simple money and investing tips. Let's begin. Investing money is an essential aspect of financial planning that can help individuals achieve their long-term financial goals. Whether it's saving for retirement, buying a house, or funding a child's education, investing can provide a means of growing one's wealth over time. However, investing can also be intimidating, particularly for those who are new to the process. The fear of making the wrong investment choices can prevent individuals from taking the necessary steps to start investing and reaching their financial goals. People are also uncertain about the order to invest their money in. What if they are investing completely wrong? We're going to explain step by step in which order you should invest your money. Step 1. Building an emergency fund. An emergency fund is a crucial component of any financial plan. It is a sum of money that you set aside for unexpected expenses or emergencies, such as medical bills, car repairs, or job loss. Having an emergency fund can provide a sense of security and peace of mind, knowing that you have a financial cushion to fall back on when unexpected events occur. The importance of having an emergency fund cannot be overstated. Without one, you may be forced to rely on credit cards, personal loans, or other forms of debt to cover unexpected expenses, which can lead to a cycle of debt and financial stress. Having an emergency fund allows you to handle unexpected expenses without going into debt, which can help you maintain a healthy financial future. The amount you need to save in your emergency fund depends on your personal circumstances. Financial experts typically recommend saving 3 to 6 months' worth of living expenses. This amount can vary based on factors such as your job stability, health status, and other financial obligations. It is important to assess your individual situation and determine how much you need to save to feel financially secure. To illustrate the importance of an emergency fund, consider the following personal story. Jane was a young professional who had recently started working at a new job. She was excited to have a steady income and was looking forward to saving for her future. However, just a few months into her new job, Jane was unexpectedly laid off due to budget cuts at her company. Without an emergency fund, Jane was forced to rely on credit cards and personal loans to cover her living expenses while she searched for a new job. It took her several months to find a new job, and by the time she did, she had accumulated a significant amount of debt. If Jane had had an emergency fund, she would have been able to cover her expenses without going into debt and would have had a much easier time getting back on her feet. Step 2. 401k Employer Match. A 401k is a retirement savings account sponsored by an employer. A 401k employer match is when an employer contributes a certain amount of money to the employee's 401k account based on the employee's own contributions. The employer match is usually a percentage of the employee's salary and can be a valuable benefit for employees to take advantage of. One of the primary advantages of taking advantage of an employer match is that it allows employees to save more for retirement without having to increase their own contributions. For example, if an employer offers a 50% match on the first 6% of an employee's salary that they contribute to their 401k, an employee who contributes 6% of their salary will receive an additional 3% from their employer. This means the employee's overall contribution to their retirement savings is now 9% of their salary, without having to save any more of their own money. On the other hand, if an employee chooses not to take advantage of an employer match, they are essentially leaving free money on the table. Not only are they missing out on the additional contribution from their employer, but they are also missing out on the potential growth of that money over time. It's also important to note that some employer matches have a vesting schedule. This means that an employee may not have immediate access to the full amount of the employer match. Instead, they may have to work for a certain period of time, known as the vesting period, before they can fully own the employer contributions. For example, an employer may have a vesting schedule that allows an employee to own 20% of the employer match after 1 year of service, 40% after 2 years of service, and so on, until they are fully vested after a certain number of years. Step 3. High-interest debt reduction. High-interest debt refers to any type of debt that has an interest rate that is significantly higher than other types of debt. Examples of high-interest debt include credit card debt, payday loans, personal loans, and some types of student loans. It is important to get rid of high-interest debt as soon as possible because it can accumulate quickly and become unmanageable. The interest rates on high-interest debt are typically much higher than other types of debt, which means that you will end up paying more money over time if you do not pay off the debt quickly. There are two popular methods for reducing high-interest debt: the debt snowball method and the debt avalanche method. The debt snowball method involves paying off your debts in order of smallest to largest balance, regardless of the interest rate. This method is designed to provide a psychological boost by allowing you to see progress quickly as you pay off smaller debts first. The debt avalanche method, on the other hand, involves paying off your debts in order of highest to lowest interest rate, regardless of the balance. This method is designed to save you the most money on interest over time. Both methods have their advantages and disadvantages, and the best method for you will depend on your personal financial situation. It is important to consult with a financial advisor or credit counselor to determine the best method for your specific needs. Step 4. IRA. An IRA, or Individual Retirement Account, is a type of investment account designed to help people save for retirement. There are two main types of IRA: traditional and Roth. Traditional IRA. A traditional IRA allows you to make pre-tax contributions, which means that you can deduct the amount you contribute from your taxable income for the year. This can reduce your tax bill for the year, and the money in the account grows tax-deferred until you withdraw it in retirement. At that point, you will pay taxes on the withdrawals as regular income. Roth IRA. A Roth IRA, on the other hand, allows you to make after-tax contributions. While you won't get an immediate tax break, your money grows tax-free, and you won't owe any taxes when you withdraw the money in retirement, as long as you follow the withdrawal rules. Advantages of IRA. The main advantage of an IRA is that it offers a tax-advantaged way to save for retirement. Depending on the type of IRA you choose, you can either defer taxes on your contributions and/or earnings until retirement or enjoy tax-free withdrawals in retirement. Additionally, you have control over the investments in your IRA, so you can choose investments that align with your risk tolerance and investment goals. How much to contribute to IRA? The amount you can contribute to an IRA each year depends on your age and income. In 2023, the contribution limit for both traditional and Roth IRAs is $6,000 per year, with an additional catch-up contribution of $1,000 if you're age 50 or older. Eligibility requirements. To contribute to a traditional IRA, you must be under age 70 and a half at the end of the year, have earned income, and not exceed certain income limits if you or your spouse are covered by a workplace retirement plan. Anyone with earned income, regardless of age, can contribute to a Roth IRA, but income limits do apply. Overall, an IRA can be a valuable tool in your retirement savings strategy, but it's important to understand the different types of IRA and the rules that apply to each, as well as your eligibility for contributions. Step 5. Each SA. A health savings account, each SA, is a type of savings account that allows individuals with a high deductible health plan, HDHP, to save money tax-free for medical expenses. Contributions to an each SA can be made by either the individual or their employer. The advantages of an each SA include tax benefits, flexibility in choosing medical providers and treatments, and the ability to roll over unused funds from year to year. Contributions made to an each SA are tax-deductible, and any interest or investment gains earned on the account are tax-free. Withdrawals made from an each SA for qualified medical expenses are also tax-free. The amount an individual can contribute to an each SA each year is determined by the IRS and can vary depending on whether the individual has self-only or family coverage under their HDHP. For 2023, the contribution limit for those with self-only coverage is $3,800, while the limit for those with family coverage is $7,650. To be eligible to contribute to an each SA, an individual must be enrolled in a high-deductible health plan, HDHP, and not be covered by any other health insurance plan, including Medicare. Additionally, the individual cannot be claimed as a dependent on someone else's tax return. Overall, an each SA can be a valuable tool for individuals with high-deductible health plans to save money tax-free for medical expenses and potentially earn investment gains on their contributions. However, it is important to carefully consider eligibility requirements and contribution limits before opening an each SA. Step 6. Mortgage payments. Buying a home is often the biggest investment people make in their lives. However, owning a home also comes with a significant financial responsibility: mortgage payments. It is important to understand the benefits of paying off your mortgage early, as well as the risks of not doing so. Paying off your mortgage early can have many advantages. Firstly, you can save a significant amount of money in interest payments over the life of the loan. Depending on the size of the loan and the interest rate, you could potentially save tens or even hundreds of thousands of dollars in interest. Additionally, paying off your mortgage early can provide peace of mind and financial security, as you will no longer have the burden of monthly mortgage payments. On the other hand, there are also risks associated with not paying off your mortgage early. One risk is the possibility of losing your home if you are unable to make payments due to unforeseen circumstances such as job loss or illness. Another risk is the potential for high interest rates, which can make it difficult to afford mortgage payments and lead to default. If you decide to pay off your mortgage early, there are several strategies you can use. One approach is to make extra payments on your mortgage each month, which can help reduce the principal balance and save you money in interest over time. Another option is to refinance your mortgage to a shorter term, which can help you pay off your mortgage more quickly. In conclusion, the most optimal order for investing money depends on each individual's unique situation, but a general guideline can be followed. Building an emergency fund should be the first priority, followed by taking advantage of any employer 401k match. Next, high-interest debt should be tackled using either the debt snowball or debt avalanche method. After that, investing in an IRA, and each SA can provide additional benefits. Finally, paying off the mortgage early can provide long-term financial security. It is important to keep in mind that every person's financial situation is different and may require different priorities. Seeking the advice of a financial professional can be a great way to determine the best course of action for your specific situation. Ultimately, taking steps towards financial stability and investing in your future is a crucial aspect of achieving long-term financial success. If you liked the video, please subscribe to the Finance Bowl, where we give simple money and investing tips. Until next time.